What if I told you that Warren Buffett isn't a fan of dividends? It's true. While most investors flock to dividend-paying stocks, Buffett's strategy is surprisingly different. But what does he know that others don't? In this video, we're diving into the surprising truth about dividends and whether they really matter when it comes to making smart investment decisions. Stick around, because what you're about to learn could change the way you think about your portfolio. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. When a company turns a profit, it has a few options: reinvest in the business, pay out dividends, or buy back shares. So what would you rather have? Cash in hand from dividends now, or let the company reinvest that profit for a potential 15% return? Warren Buffett is a fan of the latter. He prefers companies that reinvest their profits to fuel growth. While you might not see that money right away, those smart investments could lead to even bigger profits down the road, boosting the company's overall value. In his 2012 annual letter, Warren Buffett noted that a profitable company has several options for using its earnings. The first priority, according to Buffett, should be reinvesting in the business, whether that means improving efficiency, expanding into new areas, enhancing product lines, or strengthening the company's competitive edge. If a company can reinvest its profits effectively, it's likely to deliver greater value over time than if it simply paid out those profits as dividends. However, not every company has the opportunity to reinvest. Sometimes they're too large, or the right investment opportunities just aren't available. When a company doesn't have good opportunities to reinvest its profits, it can either pay dividends or buy back its own shares. A share repurchase or buyback involves the company buying its own shares from the market. This reduces the total number of shares available, which in turn increases earnings per share. As a result, a higher earnings per share is looked upon favorably by investors and can boost the market value of the remaining shares. When a company repurchases its shares, it actually increases the value of your ownership. For example, if a company has 100 shares and you own 5, that's 5% of the total. If the company buys back 10 shares, reducing the total to 90, your 5 shares now represent 5.55% of the company. This is how buybacks create value for shareholders. One major benefit of share repurchases over dividends is that you can avoid the taxes that typically come with dividend income. This tax efficiency is one of the reasons Warren Buffett prefers companies that buy back their shares rather than paying out dividends. At his own company, Berkshire Hathaway, Buffett has opted to repurchase shares instead of distributing dividends to shareholders. The idea that dividends are irrelevant traces back to the 1961 paper, Dividend Policy, Growth, and the Valuation of Shares by Merton Miller and Franco Modigliani. In their paper, they argued that in a world without trading costs and taxes, investors should be indifferent between receiving a dollar as a dividend, since the stock price drops by $1 in this case, or by getting a dollar by selling some shares. This principle holds true because a dollar is always worth a dollar, regardless of how it's received. Dividends aren't inherently bad, but they shouldn't be a key factor in your investment decisions. Imagine passing up a fantastic company with strong competitive advantages just because it doesn't pay dividends. Instead, focus on whether a stock represents a solid business with long-term potential. Many successful companies, like Amazon, Netflix, Berkshire Hathaway, and Monster Beverage, don't pay dividends yet still deliver impressive returns. So when I say dividends are irrelevant, I don't mean they're negative. They just shouldn't be the main reason you choose or avoid a stock. This principle holds true regardless of whether the stock market is rising or falling. If the market is down and a dividend is paid, the company's value will drop by the same amount as the dividend. In other words, receiving a dividend during a market downturn is effectively the same as selling some shares during that downturn. In his book Common Stocks and Uncommon Profits, Philip Fisher addresses common misconceptions about the value of dividends. He notes, "It is possible that by using earnings not for dividends, but to build a new plant, launch a new product line, or install major cost-saving equipment, management might actually be doing more for shareholders than if it had simply distributed those earnings as dividends." Fisher argues that investors generally prefer a company that can reinvest its profits to create even greater value. Many people overlook that retained earnings used for investment can often generate more value than distributing those earnings as dividends. Let's look at an example. Jim runs a store making $100,000 in annual earnings. He has two choices: take all that money now, or invest it in opening a new store that could eventually double his earnings to $200,000. With the profits from both stores, he could open yet another store, continuing to grow his earnings further. This illustrates how a company can create substantial value through reinvestment rather than paying out a dividend. So while dividends might seem attractive, they aren't the ultimate factor in assessing a company's investment potential. Remember, the true measure of an investment's worth often lies in how effectively a company uses its profits to drive future growth. By understanding the true impact of dividends, you can make more informed investment decisions and potentially uncover more rewarding opportunities.